Hey, what's up, guys? My name is David, and today I'm going to talk about the core mechanics of Nirvana Finance so that you can understand how up-only technology works. ANA is the first token ever created with an up-only floor price. On top of that, it offers interest-free loans and leverage with zero liquidation risk, plus a high yield from staking. If you're a seasoned crypto investor, your BS alarms are definitely going off, because honestly, this all sounds too good to be true. And given the crypto landscape, it would be completely fair to assume that a project with such incredible claims will collapse like a house of cards when the music stops. But that's what separates Nirvana from the rest of the pack. It's actually sustainable. It is designed to be uncollapsible no matter how bearish things get. That's what makes Nirvana a diamond in the rough. So rather than trusting me on that, I encourage you to stick with me because I'm about to explain the core mechanics of Nirvana so that you can see for yourself what a brilliant and sustainable system Nirvana truly is. So by the end of the video, you'll understand how ANA maintains a mathematically guaranteed up-only floor price and how Nirvana offers leverage on ANA with zero liquidation risk, all while paying yield to stakers. So let's jump in. The engine at the core of Nirvana is the revolutionary market maker called the market-driven mint. The MDM is what facilitates the buying and selling of Nirvana's store of wealth token, ANA. ANA is minted on demand, meaning anytime ANA is bought from the MDM, it's minted, meaning new ANA is created. And when ANA is sold back, it's destroyed or burned. The protocol sets the market price for ANA so that it raises when supply increases and falls when supply decreases. So the protocol started with zero ANA tokens in existence with no insider allocation or vesting. That means that every single ANA token that exists was paid for by its owner with stablecoins. So here's a key point. All of the stablecoins that are used to mint ANA are held in the MDM to serve as exit liquidity for everyone who wants to sell it. So here's a way to visualize the market-driven mint. Let's say that the starting price for ANA is 1 cent. So when the first person buys ANA, they mint that ANA token in exchange for 1 cent. So the ANA supply moves from 0 to 1, and 1 cent is deposited into the MDM. Now, let's say someone decides to mint a second ANA token. The algorithmic price curve in this example is set so that the ANA price increases by 1 cent for each new ANA token that's minted. So when someone decides to mint a second ANA token, they have to pay 2 cents. And then a third ANA costs 3 cents. Now we have 3 ANA in existence. But let's say that all 3 owners decided to sell. The first person to sell their ANA token will get 3 cents back, and their ANA will be burned, bringing the supply from 3 to 2. The next seller will get 2 cents, and the third seller will get 1 cent. And now there are no more ANA tokens. So now we have a simplified understanding of how Nirvana's MDM changes ANA's price as its supply changes. So in summary, Nirvana uses an algorithmic price curve to determine how to allocate its stablecoin liquidity for ANA and how quickly price changes with supply. Now for the fun part. Let's look at how the MDM creates a rising floor price. Take a look at this price curve for ANA. The liquidity is allocated so that each ANA sold is worth 1 penny less than the previous. But what if we wanted to take some liquidity from this section of the curve and move it over here? We still have the same exact amount of liquidity, but now this ANA sold at supply of 3 is now worth 2 cents instead of 3. But in exchange, the ANA sold at supply of 1, meaning the last ANA ever sold, would now also sell for 2 pennies. So by simply shifting the price curve, thereby moving the liquidity, we can increase the minimum price that ANA will ever sell for, even if every single token was sold. And we can repeat this process, essentially sacrificing liquidity at higher supply and price levels in exchange for more liquidity at low supply levels, resulting in a higher minimum price for ANA. Again, even if every ANA were sold. And we can continue this until there's not enough liquidity above the floor price to support a floor raise, in which case we'll have to wait for more investors to buy ANA, thereby adding more liquidity to the protocol, so that we can then use that liquidity to raise the floor again. The price point where there's enough liquidity to raise the floor by 1% is called the trigger price. So once ANA's price reaches or goes beyond the trigger price, the floor price is able to raise 1% up to once every 2 hours. So now we understand ANA's mathematically guaranteed rising floor price. Next, let's talk about another feature that sounds too good to be true, but is interest-free loans and leverage with zero liquidation risk. Here's how it works. Anyone can stake ANA and borrow stablecoins with that ANA as collateral. The stablecoin you borrow is called NERV, and it's essentially wrapped USDC. The amount that you can borrow is equal to the floor value of your ANA tokens. So, connecting the dots, your collateral will never be worth less than your loan. Therefore, it will never be liquidated. In fact, Nirvana doesn't even have a liquidate function. And of course, this is only made possible because ANA has a mathematically guaranteed floor price. And the same holds true if you want to use your loan for leverage. You can stake your ANA, take a loan against it, and buy more ANA. And then you can stake that ANA, take out another loan against it, and repeat, effectively creating leverage. Yet the same truth remains. Your loan collateral can never be worth less than your loan, no matter how many times you loop it to get more leverage. So, at this point, we've covered how ANA maintains an impenetrable floor price and how that enables leverage with zero liquidation risk. Next, let's talk about how Nirvana is able to pay ANA stakers a real yield without compromising the integrity of the protocol. When you stake ANA, you receive a token called Prana. Prana is a special token that works like a call option. It allows you to mint ANA in exchange for only the cost of the floor price rather than the market price. So if the market price of ANA is $4 and the floor price is $2.50, you could realize one Prana token, pay $2.50, and receive one ANA, which you could immediately sell for $4, netting you a profit of $1.50. In other words, the value of Prana is the difference between ANA's market price and floor price. Here's how we can visualize realizing your Prana. Let's say I decided to realize one Prana. Because the floor price is 2 cents in this example, I can pay 2 cents, create a new ANA token. And you can see that I'm simply extending the section of the price curve supporting liquidity at the floor, but it never compromises the floor, no matter how many Prana I realize. In addition, Prana also serves as Nirvana's governance token, which allows you to vote on various parameters and protocol fees that shift incrementally each week, and on whether or not the floor will raise if the trigger price is hit. On top of that, you can stake your Prana and earn a share of protocol revenue from fees. And that's it. These are the core mechanisms of Nirvana. To recap, ANA is minted on demand and the protocol stores the funds used to mint ANA as exit liquidity. When liquidity reaches the threshold where there's enough to raise the floor price, the protocol reallocates liquidity away from the market price sell depth and towards raising the minimum price of all ANA forever. Staking ANA allows you to borrow NERV against your ANA, but only an amount equal to the floor price of your ANA, which eliminates the risk of liquidation, even if you decide to loop your loan back into ANA for leverage. And of course, staking ANA will yield you Nirvana's governance token, Prana, which allows you to mint new ANA for only the cost of the floor price. And it also earns protocol revenue and allows you to vote. So to conclude, let's briefly touch on the implications of these core mechanics. ANA's guaranteed floor price makes it an asset with limited downside risk and unlimited upside potential. The closer Ana's market price gets to the floor price, the greater the incentive is to buy and hold Ana for two reasons. One, the downside risk is lower. And two, the leverage you're able to attain by looping your nerve loans is higher. In other words, the closer Ana's market price comes to the floor, the more asymmetric your risk to reward becomes. And at the floor, the asymmetry skyrockets to infinity. The results of this dynamic is that in a rational market, Ana's price will always trade above its floor price. And that is the very condition required to keep raising the floor, as well as to keep paying a valuable yield. And so Nirvana has created a self-perpetuating feedback loop designed to send the price up and to the right forever. This is why I say Nirvana is the biggest innovation to finance since Bitcoin. And this innovation is bigger than just one protocol. They've given birth to a new sector of the economy, algorithmic wealth storage. And I believe this sector will absorb a significant share of global liquidity. And when I say significant, I mean tens of trillions of dollars. But nobody understands this yet. Nobody is talking about this. And I don't know, maybe I'm wrong. Maybe algorithmic wealth storage never catches on. But if I'm right, this is one of the biggest wealth creating opportunities ever in the history of mankind. And honestly, in my mind, it seems inevitable that algorithmic wealth storage will rise to global prominence as a sector. So that's all I got. Thanks for watching. Leave your thoughts and questions down below and drop a like if you want to help spread the word. Peace.